Hey everybody, this is Jose Blasco. We are about to get started in just a few seconds, as you can see. This is a sound check. Please go ahead and type a quick message on the chat box so I know that you hear me. A quick hello is normally what we do in normal practice. So when I get that hello message, I know that you hear me well and all is good to get started. So please go ahead and do that so we can start on time with no delay. Thank you so much. So again, waiting for those messages, those hello messages. 30 seconds to go, everybody. So we are almost there. Thank you so much. Have a little sip of water before we get started. Very nice. Perfect. Okay. Well, we're just a few seconds away from the starting time. Here we go. Here we go. Here we go. Top of the hour. Thank you so much, everybody. Welcome to the session. Today is February 3, 2022. My name is Jose Blasco. This is Options with Options. So the name says it all, isn't it? We're going to be looking at the options markets. Before we get started, I am highlighting the disclaimer on the upper left side of the screen. So please go ahead and read it carefully. This is important information. It's not too long, so please read it completely. I am indeed counting on you to do that. Agenda for today, as always, we follow a very similar structure in most of the sessions. We are looking at the market, we understand what's happening in the market, we then review what's happening to some of the trades that we may have running in our accounts. We talk about trade management, and from there we look for new opportunities. Today is Thursday. There are certain weeks where we meet at least with myself, Jose, a couple of times during the week, and we tend to use the first day to do or focus more on trade management, trade review, while we tend to use more the second day for opportunities. Today it's Thursday and happens to be the only day I am meeting with you guys this week. So in this sense, I'm going to fly through trade management. So hopefully we can focus on trading opportunities and find setups that meet our rules so we can be ready to click the button if that's what you want to do. Good to see you, Christian. Good to see everybody. Very nice. Okay, so I'll get rid of the introduction slide. I wanted to also highlight the fact that we have a page that we use for questions and answers. This is tradewithufos.com/Jose in my case. If you are working with Josip, Boyan, Becky, Pedro, Reynaldo, etc. So you just add the name of your instructor at the end. And when you come to this page, so obviously there are plenty of questions or comments already posted here. You can certainly search, and often you may find answers to your questions already waiting for you. If you have a question for which you don't have an answer and you're looking for, so you just log in and then click on the green button, and then you can go ahead and ask your questions. Okay. In the sessions, we always use trading technology, which is what we do as a technology company, isn't it? So here in the upper part, you also have a quick highlight, a quick menu where you can click on it and basically get access to the various tools that we utilize, most of the times the Predictive Options Planner, especially when we do the options sessions. Okay, so with all of this said, let's go ahead and jump in the markets and begin with our market analysis so we can prepare for the session and go for it. So first of all, S&P 500, what is happening? Okay, well, take a look at the climate. We have a blue color there in the climate, but notice how we are dealing with thin dots versus thick dots. So they are thin, meaning that the climate is not confirmed. There is a directional component pushing up or pointing to the upside, but that is not strong enough or decisive enough to be seen as a market which provides a statistical edge by going long. Okay, so in this sense, caution is to be applied. Of course, this is if you are using the daily time frame, which is normally what I use when I do the analysis. You may be more active and use a lower time frame. You may be more passive and use maybe a 2-day time frame, a 3-day time frame, a weekly time frame, and then of course your climates, your market waves, if you wish, your market cycles. Another way to think about it would be set differently because obviously you change time frame, you change the whole reference model, right? But again, with the daily time frame, we need to exercise caution because we don't have a statistical edge when it comes to being directional out of what we get from the S&P. This is very relevant because, as we often comment on the session, stocks are a fragile asset by definition. And when I mean fragile, it doesn't mean it's a bad thing. It's just like you're drinking coffee with this beautiful, fragile cup of very fine porcelain or something like that. So it's a fantastic thing to have, to be honest. But you gotta treat it with care because it's fragile. If it falls on the floor, it's gonna break. Same thing happened with stocks. They are great, but they are depending on many external forces, forces such as other stocks, which can be competition stocks, could be sectors, market groups, could be other market indices. We are looking at the S&P, which is what I normally do. Certainly, a deeper market analysis would be done if you also look at the diamonds, if you also look at the Russell, where you got the small caps, if you also look at the QQQ or the Nasdaq index, where you have many of the technology companies and biotechnology as well. And again, when you look at all of that, you would have an even better understanding. But my point is that stocks are depending on all of that, and you may have this perfect setup, but next thing you know, because the S&P is not decisive enough, which in this case is not, hence the climate being unconfirmed. So then next thing you know, your stock may not do what you expect it to do, or maybe it just does nothing at all, doesn't really move. So again, it's really this type of market environment. Normally, it's the ideal market environment for us to think more of non-directional trading than to be aggressively long, aggressively short, unless we are dealing with very special type of opportunities. And in my mind, and certainly I would like to explore that with you later today, guys, in my mind, I'm thinking of that particular stock, which probably most of you or all of you are aware on, Facebook being down by 25% after extremely disappointing earnings, and it's like the world is ending for that stock, which probably is not ending, and maybe by doing some analysis we find some unique market opportunity here, such given the nature of that company, which is obviously very relevant, and the size of the move, which is humongous, right? A 25% drop in one day, it's really something significant. So in other words, in general, the right action or the safe action to be taken out there in a day like today would be to be thinking of doing non-directional trading and take it very easy with those directional trades. Or if you were to go long, find hedges to be short, or if you were to be short, find hedges to be long. On top of that, when we look at market data in the form of volume map, okay, options that are coming from the options arena, we can see that 1.1 times more puts, gray color, are being traded compared to the calls. 1.2 times more puts here, 1.3 times more puts, 1.4 times more puts, but not many of those expiration dates are surpassing the averages. And if any, the calls are above the average on February 7 expiration, but also the puts are also beyond the 5-day average when it comes to traded volume. So in other words, it's almost the same amount of calls and puts being traded, and therefore we end up with values of implied volatility which are extremely close. I mean, today, intraday, it seems that the puts are winning a little bit with implied volatility of 19 for the puts versus 18 for the calls. But when we look at it as an average, which is what I have on the left, right, which is the average of the last 3 days. So we can see how the puts and the call are exactly showing a 17.33% implied volatility value, meaning that really, there is a reason why the market climate is showing, unconfirmed, really lots of market data, both price movement seen in the form of, candlesticks and the chart moving up and down, as well as options data. Everything is kind of pointing at, anything could happen really. Also, when looking at the UFOs, you can see the next red UFO is quite far, but also the next green UFO is quite far. So there is nothing close by. So you could see the market take a dive and then go back up, or take a rally and then drop. Anything could happen. Okay, this is one of those days. And if I was to bet in a specific direction, then the one thing I would say is that careful here. If the market closes where it is trading today, we're going to have an Elliott wave turning point identified pointing down. That would be a long-term Elliott wave, meaning that we could get to see the S&P fall all the way to around 400. Again, this is too soon for me to say because that Elliott wave turning point will not be confirmed until the candle closes. If the market was to rally higher, maybe that orange dot will go away from the chart. So this is not confirmed. But if the market closes where it is or below, then that potential new wave pointing down in the market, with a target, around 405 or something like that, it's indeed a possible target, and therefore we can see, a strong movement to the downside as a continuation of the prior waves. Okay, so so that's where we're at. Again, lots of information that invites to being careful and wait a little bit until the market gets just a bit more definition. Okay, good. So this is what we see from the S&P now, because the market went down by 1.12% today. So there is a little bit of a rally in implied volatility compared to yesterday, which is now trading at 22 point something. So again, when looking at non-directional trades, typically with 20 something percent volatility, it's doable to find trades that may have an okay reward to risk ratio and probability, meaning allow us to trade ranges which are relatively wide, and then we are happy to go for it. So I'll be researching into that. The first thing I'll do is, given the very unique situation with Facebook, so that's the first thing I'm gonna assess, see if we can put something together which is nice and powerful for Facebook. Next one in line will be to go ahead and talk about non-directional trades. That's the plan for today, after I review the positions that we have in the account, which I'm going to do very quickly today. Okay. Good to see you, JC. JC, I'm not sure, JC. Sometimes, obviously, because we have made those temporary changes on the website, and we're using the YouTube engine to stream, even though it's unlisted streams, which is a private streams on our website, while we're using the YouTube engine, while we are completing some additional changes on the website that will take some time still. Obviously, when you guys are entering the chat box, you're using some of your YouTube usernames, which sometimes maybe a family member or something like that. So sometimes I may not know exactly who you are. Okay, so JC, I'd love to know if you could type your name, so that way I understand who you are. That would be great. Here we go. So Yelp. Okay, well, Yelp, we don't have too much to say. It's the same story about Yelp since the trade started. Same thing I commented last week. If I shrink those candles, so we entered here, that stock gave us a little bit of hope, if you wish, when it was rallying back up, but then went down again. So again, we already butterfly it. We are already managing our risk the most we can at this moment in time. So that's it. Okay. Certainly, if the stock rallies again, then we'll deal with it. We still have until February 18, so another, let's call it, close to a couple of weeks, and then we'll be done. With LEN as well as Qualcomm, very similar scenario with LEN and Qualcomm, where we took these trades on that specific date. I believe they were taken on the same day, and LEN went against us all the way. Again, we talked about it last week, that when that stock gapped up on that particular trading day, if you had converted this particular spread into a butterfly or a condor, you'd be pretty okay with the trade. I didn't, so obviously the P&L for this trade on my end doesn't show too good, because I never helped to offset the risk of the trade as that stock moved completely in the opposite direction versus what we were expecting when we entered here in this blue climate, and immediately we had lots of red coming in. So so that's what we have with LEN. With Qualcomm, that one is okay in the sense that we've been working on this trade already. This particular market is currently trading at 182. To be honest, this is a trade that you should have closed if you followed the guidance, the comments that we have been discussing before. Why is that? Because look, if we look at the risk graph of this trade, looks like that, isn't it? So where is the maximum profit for this trade? Well, the maximum profit obtained is 192.50, and that stock, as you can see, did reach 192.50 a couple of days, 2 days ago, and also yesterday almost. Okay, and at that time, that's when we had the best P&L available at this moment in time. And given the fact that this was a long trade that we had to let's call it butterfly, even though it's not exactly a butterfly. So we had to act on it for trade management purposes because the stock went against us as well. So as that stock was reaching the midpoint of this trading strategy, this structure, all the way between all those units. So that was the ideal exit point, and you guys should have closed this trade, which have been a very nice profit. At this moment in time, this trade is showing a 110. Look at the midpoint, 67.5 now if we look at the midpoint. But again, that was $100+ of profit, easy, 150 or something like that if you close the trade on the prior day. Okay, so I'll leave it open so we can talk more about it. But if this particular trade rallies, you could certainly go ahead and close it. And if you would like to basically have some automated type of order to be able to close this, so something that you can do is use a conditional order. So you can come here. This is TOS. So we have our trade here. So sorry, not like that. I want to select the whole thing. So, okay, I'm not sure why it's not allowing me. Okay, now, so create a closing order. So if I buy it back, okay, if I buy back the Iron Condor, what I could do is, instead of buying it back for a specific price, I could make this to be a good till cancel order. Click on the settings wheel here, which will bring me the window that allows me to add additional type of rules. Okay, and when it comes to here, the only problem I'm going to have here is that if I use a market order, okay, and I set this with greater than or equal to 192.5, so this is going to execute a market order to get out. The problem with a market order is that I may get significant slippage. If you go back to top and you look at, for example, the ask price and the bid price, so we're talking about 815 to 860, 1120 to 1175, 247 to 277. So you got a decent amount of cents of difference between bid and ask for most of those units. And if you use a market order, especially if you were to get filled, let's say right at the open, you may get a very, very, very bad surprise when it comes to how bad a surprise you got on the way out, and that would be very problematic. So what can you do? Well, depending on the platforms and the brokers that you use, okay, and also the type of strategies that you use, so you may set a limit order, okay, where what you're doing is that you are basically looking at the mark. So it's whatever mark, it's another way to say midpoint, okay? Mark is another way to say midpoint between the bid and the ask. So in other words, whenever that stock reaches 192.5, whatever the midpoint of the spread is will be placed as a limit order to exit this trade. Of course, it's a limit order with a limit price set at the midpoint between the bid and the ask. So you may get filled or you may not get filled depending on the liquidity available at that moment in time, the width of the spread, the willingness of those market makers to take the other side of your trades, etc., etc. But at least now you have certain level of control over slippage, and you don't just do a market order, which would be very problematic. So this is something you can do. And as an extra rule for this type of strategies, especially when you have multiple legs, it's not a bad idea to also add a time condition. Okay, a time condition where, for example, you say, look, I'm okay to get filled, but only if it's already, I don't know, let's say 9:40 in the morning New York time, meaning the market has been open for 10 minutes already and the spreads are starting to stabilize. Problem of doing that is that if you do this, then you need to come back here and every day you need to change the date, because that condition does not allow you to have a time condition only. It's actually date and time. Okay, so you cannot just delete the date and go like that, because the moment I change, you can see it replaces the date automatically. So again, I'd go without the time, but certainly it's something that I would watch before the market opens to see if Qualcomm is likely going to trade at 192.5 right at the open, and then I would just cancel the order and just wait 10 minutes and then place it. Anyway, so I'll put this in, so then we can see. And remember, I use a good till cancel order. Okay, I'm doing this fairly quickly, but hopefully you are with me. I use the good till cancel order. So whenever that happens, if that was to happen, so I will be out of this trade. Cool. What else? EOG. So that one, I don't need to comment. This was a trade that went very, very, very much against us. Again, it was a hedge, so the amount of risk of this trade was very minimal. Again, if you had been around, which I was not, when the stock came back very close to the entry point, you could certainly have reconverted this credit spread into an iron condor or a butterfly, and then you would be fine. You actually would be in a nice profit. I didn't, and therefore, because the stock moved so much against me, so this hedging trade is not hedging anything, is actually suffering a loss, which is maximum 90 something. So not a big deal, but you can see here maximum risk 95, and that's where we're at. And probably this trade will end up like that since expiration is February 18. And finally, FedEx. Okay, this is a trade where we may need to act. So FedEx is an iron condor that we put together some time ago. I am going to move here into FedEx. So, so in the last session together, our original upper part of the range was where the red line is. But because we were able, when that stock was falling very aggressively, we had a situation, um, either that day or the day after. I'm not sure now. I think it was the day after, maybe. Yes, the day after, or maybe even the day after. I think that exactly. I think that was the day when we did the adjustment. So you can see here how on the expiration date, which is that vertical line, our probability cone line was crossing our purple line, which is the extreme of the range based on the UFOs. So this is telling you danger to the downside. That stock may now statistically surpass the extreme you thought was the extreme, may not be the extreme anymore, statistically speaking, and therefore we went ahead and we did a conversion of this trade. Okay. Now what happens is that so then the market rallied back up. Okay, and everything seemed to be okay for a few days, where the top and the bottom of that statistical range was within the purple line below and within the purple line above, so we were okay. But notice how if I go back to today, for example, so today there is a minor challenge, okay, on the upper part. Okay, minor. Okay, so it's looking like it's surpassing a little bit here. So our top line is 271.80, and we are talking about 272 instead of 271.80. So we are now detecting a statistical risk where what we think is our upper limit for the range may be threatened and may be violated, and price trades through that beyond and above. And obviously, if that's the case, then our current iron condor will suffer. Okay, will suffer. So what can we do? So let's take a look. Okay, so our iron condor. Wait a minute. So FedEx. So 230, 235, 280, 285. Yes, correct. Okay, so that's what we have. Very good. So what will we do? Okay, so what will we do now is, okay, so since the upper part of the range seems to be in danger, so now what you will do is that you will look at the bottom part and try to move the below puts higher, right? So remember, an iron condor, for the ones of you that are newer to trading options, an iron condor is made of buying a call and selling a call above, and on the bottom part, selling a put and buying a put below, right? So when the upper part is being challenged, what we do is that we take the below units and we move them higher. What do we accomplish by doing that? Well, we sell new puts above where the below puts were. So we take new credit and it's greater because the new puts are nearer to the current price compared to the original puts, which are further down. But also, because the market went higher and time has passed, so normally you can go ahead and close those puts for a profit. So basically, you collect a profit from those puts and then you sell puts at a higher strike. which is something that improves the performance of the trade, because the more credit you collect, while you may maintain the same risk set as the difference between the strike you buy and the strike you sell. In this case, 230 to 235, that's $5, or 280 to 285, that's $5. So you have a maximum, what they call the raw risk of $5, $500. But as I keep collecting more credit, those $500 are diminished by the total credit collected. So because I'm going to sell new put at a higher price, I'm going to collect more credit, and therefore I keep lowering my risk as I am finding a possible threat. I keep lowering the risk of the trade. This is the type of trade management that we do. We keep doing that during the life of the trade. And ultimately, if the range was going to be broken, then what we do is that we convert the iron condor into a butterfly to add an extra great amount of premium and give the trade a second chance by replacing the range where profits would be taken. Okay. Again, this is in a nutshell, and at the same time, very, very fast. A summary of the things that we do when it comes to trade management for condors. Nothing new for the ones of you veterans of the sessions, okay, but I wanted to kind of like rephrase it so everybody's in the same page. So now, what's the issue? Well, the issue is that for me to be able to take the bottom puts and roll them higher, I need that line, right, that statistical line, to be higher. So if my statistical line was, let's say, something like that, and was here, so now I would be able to draw a new horizontal line. And now I would be able to go and find, no new UFOs below. And next thing you know, now the purple line, which is currently here, okay, maybe I'll be able to move it somewhere here. That would be my new range, and then I would be selling puts right under instead of puts, wherever they are now, somewhere here probably. So now, what's the issue? Well, the issue is that the red line, it's basically pointing at the same place where my original red line was. So in other words, while it seems that I am having some level of risk that is now threatening the upper part of the range, the problem is that volatility has increased across the board, and therefore everything is widening. The probabilities suggest that the statistical range from now until expiration is, even though time has passed, the statistical range is very, very likely going to be the same. Okay, and therefore, so we cannot act on this trade yet. We need to wait a bit more. Maybe we need the market to rally a bit higher. So this red line will represent a little bit of a greater threat on the upside, but also the bottom line will actually move a bit higher as well. As we can see now, is moving just a bit, and that may allow us to then go ahead and move those puts higher. So long story short, I cannot do anything yet. Okay, maybe tomorrow. So watch it, because tomorrow we are not meeting. But the possible threat, if you are in this trade, is there, and therefore a tweak it's to be applied to this trade to keep massaging the risk and the reward of the trade and the probability of the statistical range, while time is passing, moving forward on the way to March 4, which is the expiration date. Okay. Well, I did my best to go as fast as I could with the review of the trades, and I am now done. And as said before, I'm going to load Facebook, and we're going to take a look at this very unique market condition. Maybe an opportunity, maybe not. We're going to see that in a moment. And if there is one, certainly we'll plan for it. Mark, good to see you, my friend. Not a worry. It's all very, very good. Good to see you, and good to see you're with us. I'm not sure why it seems that you had problems to log in. Not sure why would that be a good idea. If you ever have problems to log in on our website, just clear your cookies, clear your browsing data, or use a different browser and try again, because while it's not ideal, as you know, I've been saying it for a while, and it will still be like that for a while. We are actually doing pretty major changes to our website that may not be visible yet, but from behind the scenes, many technology changes are being applied, and hopefully I would say March, maybe April. We'll see. We'll have a new website out there with a bit improved functionality and things like that. So we're doing baby steps into that, and again, it could be that maybe we have done some update and the cookies on your computer are still reflecting the before the update status, and then you have an issue logging in. So keep that in mind. Change browser, use an incognito window, clear your cookies. All of these may help you to log in if you ever have a problem. Cool. Okay. So Facebook. Okay. Why are we even looking at that stock? I didn't normally. The way we trade is, I load the matrix. We start looking at things. Why I'm not doing that today? Well, because it's a unique situation. Okay. It's a very, very unique situation. I mean, um, does anyone here with us today believe that Facebook is a company that will go just bust and bankrupt and will disappear in less than a week time? I don't know what's your opinion, and for sure, I don't know the answer for sure. Okay, but I would say probably not. We're in the world of digital marketing, metaverse, so odds are that what's happening to Facebook may be happening to other companies as well. If they're not doing too well with results, I would say odds are other companies may be suffering a little bit of that as well. But there will be a moment in time where I guess things will go back to normal, and that stock should go back to behave normally like it's behaved for a long time, which is quite strong. In any case, putting on the side a mini fundamental comment I just made, which is just let's say using a little bit of common sense. Okay, I'm not too much into fundamentals, even though it's indeed something very relevant in the markets, but not part of my trading style necessarily. Well, as I was saying, what I'm not necessarily part of that school of thought when it comes to being very big into fundamentals. The reality is that even if you think about it from a technical point of view, stocks tend to revert to a mean. So that stock is now very, very far away from a mean. And in that sense, we may see Facebook coming back to a higher price. So I would like to evaluate that opportunity, because what may be happening, and again, it's all maybes, but we need to check, is that notice the volatility for the stock is very high, 47% at this moment in time. Earnings have just been reported, okay, right here. Okay, that was on February 2nd, and when the market closed. And while earnings have just been reported, well, guess what? Volatility is higher than before the report, which means that this crazy move to the downside is scaring everybody. And we've been trading long enough to not to be scared and understand that sometimes a crazy move equals opportunity. We just want to assess it to make sure that we don't hurt ourselves in this plan. But certainly, we are going to be looking into that. And very good point, Christian. I'm very happy that you're also noticing that. You can see here that we got 4.3 times more calls traded than puts, 1.2, 2.2, 1.4. So long term, defining long term as February 18 or February 25. So we can see the numbers are lesser than the next expiration date, which is February 11. But at the same time, we can see that there is more calls everywhere, and certainly short term, the expectation is probably for a bounce, okay, for that stock to turn and go back higher, at least for a few days. So I would like to be able to evaluate that more precisely. Of course, I guess that there is a pretty big fight in today's trading. Implied volatility for calls and puts is absolutely equal. But again, I am not playing any of this today. I'm really going with the fact that implied volatility being so high and that stock having dropped 25%. I mean, could it drop another 25%? Yeah, sure. But, probably that's already a lot. So maybe a trade, it's something that makes sense at this point. And by the way, a good lesson, now that I see my prior drawings on Facebook here, which was an iron condor that we took, a good lesson as well. Yeah, I remember that iron condor actually. That was a profitable one that made a few of you a bit nervous, now that I remember. And a good lesson to learn here, that why is it that we avoid earnings when we do iron condors? Well, now you can see you would be out of that statistical range by 25%. That's really crazy, right? So anyway, let's come in here. I'm going to be looking at the daily time frame first. Okay, I would like to shrink this as much as possible. Okay, so we get a view of where that stock is now, and I'm looking at some of the key pivot points, okay, on the daily time frame. The nearest pivot point that we have went through is this one, because those below have not been traded below yet. So this is the lowest pivot point. And what I would like to do is I would like to add here some of the speed bumps to kind of understand if that is violated, where is the stock potentially going. Okay, so it seems that based on the magnitudes of the moves and projection of waves and all that kind of thing, we may be hitting that UFO here, which is located at 196, something like that. Okay, so again, 195, it's an interesting number for us to observe. Okay, for us to observe. Now, for us to observe that number, before I get into an option chain, I also want to look at a 2-day time frame, where also we get to see the same pivot point has been broken, that one here. And again, we project, we are also looking at this particular area where there is a UFO here from, again, 196 and below multiple UFOs. So again, those are 55% probability UFOs, and there are so many. So, I mean, having Facebook go below all that sequence of UFO could happen, indeed. But I guess you are with me if I was to say that it's quite unlikely based on probabilities. And then when we are looking at the 3-day time frame, again, we get to see again one more time the same UFO. The same lowest pivot right there is the one that has been broken. And again, we are pointing one more time at this area here, which in this case is more the 193.75 where the UFO is, which coincide with the other UFOs that we saw. Okay, so I am just confirming or reconfirming that 195 is a relevant price point. And why am I reconfirming this? Well, because I'm going to get into an option chain in a moment. And what I want to see is, if I look at the 195 options, okay, in this case, the puts, how much they pay me, okay, how much they pay me. And you can see here, 65 cents, $2.03. So again, depending on the expression, of course, the amount of premium you will collect is different. But my intention is going to be to use puts, which should be fairly overpriced at this moment in time, puts that are very, very far, in order to position myself in a way where if that stock was to fall that low, I would expect it to turn around big time. And given how many UFOs and also the speed bump is pointing at this area. So, of course, the credit collected from those puts that I plan to utilize, as we have done in other cases, would be then used to turn around and either buy calls or buy call spreads, so we can go ahead and benefit from a greater amount of positive delta. So if the stock rallies without falling all the way to 195 and just turns right now at 243 and starts going higher, so we're going to start profiting immediately. Okay, I don't need the stock to fall down to then rally, or if it rallies, profit very, very slowly, just at the rate of time decay, and basically only make a profit out of the credit collected. I would like to profit more actively and more efficiently than that, and therefore I want to add positive deltas by purchasing calls. Okay, so I'm gonna be looking at all of that, but I also want to evaluate, okay, which expiration date to use. So there are multiple things that I would like to evaluate here. So for example, if we look at this value 193 as a potential target, and I send to the strategy builders with 193.83, actually I should say 195, right? I say 195. So if I move around to 195, somewhere here, okay, and I go to send to strategy builder, this is gonna calculate the expected target for the trade, which is March 7. Okay, so given in this case historic volatility for that stock and a series of very complex calculations and projections and regression lines and a pretty interesting process, we are anticipating March 7 to be the date when that 195 price point would be hit if we get there. So therefore, I would not want to use expiration dates which are less than March 7. So when I look at my expiration dates which are available, I got March 11, March 18, March 25. So I got multiple expiration dates where all of those expiration dates will be valid for me to use. But the question is, which one is the ideal one? So what I'm going to do is I'm going to use the Skew tool to try to find which is the skew that provides me, which is the expiration date starting on March 11, okay, and then March 18, and then March 25, and then April 14, and then May 20, and then June 17, and I'll just complete the list, July 15, and then finally September 16. So I am loading calls and puts, both. And what I'm going to be doing here is I'm going to be looking at trying to find the most exaggerated drop as possible when comparing the calls and the puts. Okay, that's what I'm going to try to do, knowing that all those expiration dates should do well. Okay, should do well, given what I'm trying to do here. But oh, wait a minute. Now, okay, I don't want so many strikes. Okay, this is good enough with 9. Okay, so given what I'm trying to do, I would like to find the greatest possible angle to the downside. Why? Because on the left, okay, here we got the 195 strike, right? So the 195 strike is going to be where I'm going to be selling puts. The puts are the dotted lines. Okay, the puts are the dotted lines. So for example, notice that here, the puts in the gray color are located at this particular level. But then, if I look at calls above the current price, let's say I'm just going to use 260 as an example. So notice how, yes, the calls are lesser than those puts. Okay, the calls are lesser than those puts. Okay, and the difference between these is 52 to 40, let's call it 43. So it's like 10% difference. Okay, so I'm going to be able to sell puts which have a built-in implied volatility which is about, let's call it 10% more than the calls I'm going to buy, which are 10% less. So that's kind of like an arbitrage opportunity in a way, if you wish, where the puts are going to pay for the calls, knowing that the calls are being priced at a lesser implied volatility value. That is going to allow me to buy calls that are nearer to price, and that's going to give me more deltas because the call is going to be closer to at the money. Okay, so I'm looking for the most exaggerated angle on the way down by comparing the dotted line and the solid line being the call and the dotted line being the put. So we got around 10% with the one which is gray. If I look at the one which is red, let's do one at a time, so it's going to be less confusing. So here we are talking about like 51, and again, if I look at 260, we are talking about like 42. Okay, so again, it's about 10%, but I kind of like this one better because notice how at that level the puts actually become more expensive than the calls, which is telling me the calls have an extra cheapness built in, if I can use that word that probably does not exist in the dictionary. But you got my point. So I prefer March 18 versus March 11 based on what I've seen so far. What's the next one in line? The next one in line is going to be March 25. And let's see what's happening. So if we look at the puts here, they are trading around 49. So the calls are lower. And from 49, we're talking about 42. So here we got 7% difference, which is less than before. So then I'm going to have the tendency to ignore that one. Also, notice how the call implied volatility is above the put. Okay. And this, by the way, this just equalized now on the red one. But, again, it seemed to be a little bit a tinier advantage with the March 18. If I look at April 14, so we are talking about 46 versus 40, so it's 6%, so a little bit less of an advantage. What about May 20? So we are looking at not happy at all. 47 versus 47 versus 41 is 6%, but notice how in this case the calls are above the puts all the time. Okay, so that's not ideal. A little bit of the same is happening now with the red one, which was not a moment ago. Obviously, this is dynamic, real time, and things are changing. But yeah, notice how this seems to be very, very constant on the May 20. So I'll take the 10% from the red instead of the 6% from the magenta. Here we got 45 versus 40, so that's 5%. So it seems to be less advantageous as we go out in time. We are talking about 43 versus 38 less advantageous. And then we got September 16, which is providing 43 versus 38, so less advantageous. So based on what we just see here, it seems that the best expiration date to use to put together the type of trade I'm trying to do is March 18. So now we know, and therefore I'm now going to move into the option chain to look into that with a bit more detail. And the only expiration date I am going to leave as check mark is March 18. Okay, and I'm going to load, plenty of strikes because I'm going to need many, even though my initial observation is, okay, let me do 25 strikes should be enough. My initial observation is the 195. Okay, so the 195 is an option that pays me anywhere between 196 and 188. Okay, that's how much I would get paid for this trade. Of course, if I sell it naked, I am assuming plenty of risk. I get plenty of risk. I'm assuming plenty of risk. You have seen me do this type of trade before. I don't do it naked, so I'm gonna sell the 195, and then I'm gonna turn around and buy the 190. Okay, so I have a spread that provides me with 40 cents of credit, which this would allow me to go ahead and buy a 40-cent call, which obviously it would be so far out of the money. So again, doing this trade one time is only going to produce a tiny credit of 40 cents. And therefore, even if I do it twice, to be honest, I am now very disappointed to see this. The prices are quite disappointing in the sense that even if I do it twice, I take double the risk, okay, which is $1,000 in this case. But now I get 82 cents, which if I want to do this trade to be a cheap one, it only allows me to buy the 320 call. I just want to do it for a moment so you see why I'm disappointed. So if I buy the 320 call, one of them, so now I end up with a trade which is basically negative 3 cents. So it's basically a free trade from a cost, if you wish, point of view, from the net result from the credit and debit. But notice how the delta is just nothing. It's 8 cents. It's so tiny. So it's really disappointing when it comes to how much money you would make. Okay, so doing it like that, it's certainly not something that is appealing to me because the amount of deltas I would collect will not be enough, even if I am selling two of the put side. So not too happy. Okay, not too happy so far. Now, am I giving up? No. Let me go ahead and now move back to where I was before, which is the daily time frame, and just try to understand where a valid target could be for this trade, assuming that market is going to move higher. Because if the market moves lower, of course, and forget about it, you are not going to make money. Of course, you're not going to lose until you get to 195 or below because your credit spread is positioned there at 195. But at the same time, for you to make money with positive delta, you need that stock to rally, right? So now, if I was to plan on a target for this trade, where would a potential target be? Okay, and for that, I would like to look at an intraday time frame to see what a projection would be if we start making all-time high from this high. Actually, I just click on the wrong place. Let me make this larger so I actually can be more precise when clicking. Here we go. Okay, so if we move back higher, so we are talking about 270 something. If I go back to the daily time frame here, So 270 something, it's somewhere there in the middle of the gap, somewhere in the middle of the gap, and far from those resistance points around 290. So that would be a very conservative target to go from 243 to 270. That would be a very conservative target, but I would say nothing wrong with that. So what if I look at a near target located around, let's call it 273. So if I was to send to the strategy builder it shows as 302, so it's using March 18, perfect. So if I was to look at what is the best bull call spread to do this trade, it shows that doing the 250 to 60, okay, the 250 to 60 would be the bull call spread, which is paying the best. If we were to do this trade, the 250 to 60, this trade has a maximum risk of 362, meaning that this trade cost 352. So again, with the 80 cents we are collecting, we will not be able to pay for 362. I can show you here what I was trying to do, which is not giving me what I want. So if we do the it's 250 and 260, right? 250 and 260, correct. So if I do buy the 250 call and sell the 260 call, okay, this call combination is the most profitable one if you reach that target at 273. But because you need to pay 11 and you receive 7, so this is going to cost you 300 plus. So then your total exposure here is going to be 277. Is not a trade free of risk. So again, the calls have a lot of value built in. Probably this trade done earlier in the day would have worked quite okay, but very good observation earlier, Christian, when you said many more calls than puts. That's probably the reason why this is not looking too good. Okay, so I guess that we could we could experiment with this further by looking at other expiration dates, trying to find a combination using way longer term expressions or something like that. And maybe we find a combination that works okay to basically sell put spreads in order to buy calls or call spreads, and that may work. Okay. Now, having said all of that, I'm not giving up yet. Okay, I'm gonna give this one last chance to give us a go ahead. And by the way, let me see if you know the answer. What is the spread type that makes you directional and that tends to be the cheapest of all spread types in most of the cases? It definitely depends on the location of the strikes that you select, but in general is the cheapest, meaning if you were to compare a diagonal spread with a vertical spread, with a directional butterfly, with a ratio spread, with the various types of spreads that exist out there, which would you say, when being directional, it's the cheapest of all? Please go ahead and answer that question if you know the answer. If you don't know the answer, just tell me, I don't know. It's fine. Remember, this is a private stream, so this is between us only. We are not streaming live anywhere but here. So you can go ahead and express yourself, even if you don't know the answer, but at least you give me some feedback, so I know. So please let me know about that. I'll take a sip of water. No responses. Come on, guys. Okay. Let me bring that to the screen. Okay, I'm waiting for your response. Mark, I don't know. Okay. Okay, you typed right before I was sharing on the screen, so your message did not show up. But Mark said, I don't know. What about Christian? JC? Okay, just wanted you guys to participate. Okay, Christian, don't know. Okay, got it. Guess is an iron condor. Mark, you will pass. JC, okay, thank you for participating, guys. Okay, I just wanted to make it a bit more fun. Okay, it's not, I'm talking nonstop for an hour. Okay, so I think it was a good idea to do a little mini game here. Thanks for participating. Okay, by the way, I'll stop now the sharing the chat box. This is appreciated, guys. And the answer is a long butterfly. Okay, the butterfly, depending on the strikes you select, typically is the one that is going to make it the cheapest of all. Okay, take a look. If I use February 18 and I look at buying that 250 call and I sell the 260, but it's 2 because it's a butterfly. And then equal distance, I buy the 270. So notice how the cost of this butterfly is now $1 instead of 300 plus. Now, of course, I have limited amount of delta because the strikes are too near. Okay, the strikes are too near, and therefore I have limited delta. But I could structure my butterfly to be a bit wider, and then I pick up some delta while the cost will tend to be less than the regular bull cost spread I have here with a 250 to 60. So this is something I could consider. And this may allow me to actually find a way to have better performance on this trade than what I have now. Okay, so let's go ahead and take a look. If we do this butterfly, we buy the 250. The current price is 242. Okay, got you. So if we do it, remember the maximum profit you get on a butterfly is where the short units are. So if I was to sell the 275, remember the target was 273. So if I sell the 275, and let's say I'm gonna buy the 265, so that's gonna move my upper strike to 285. So if I was to do that, what's the cost? So that would now be 70 cents. Okay, and if the stock rallies, okay, I'm gonna make some money. Of course, as time passes, I'm gonna make money at an accelerated pace. Okay, you can see that if I move this little by little as the dates pass. Okay, I'm supposed to reach the target. I think it was March 2nd, something like that. So I'm gonna make a 273. I'm gonna be making here 273. $100+ if instead of March 3 is going to be later, I could make up to 700 plus. Again, it all depends on how much time has passed. You get a greater component of time decay, you get a greater component of negative gamma if you surpass the short strikes or as you approach the short strikes, and therefore the delta effect will be less, but at the same time you benefit from a lesser cost. So maybe another way to approach it in this case would be to go ahead and position the trade in this particular fashion. To make it a bit more interesting as well, what I could do if I want to make it a bit cheaper too, is I could actually break one of the wings of this iron butterfly. And again, those are options terms that to me they're a bit funny, to be honest. A broken wing butterfly, it's I don't know. I don't know who came up with those names. Is how it's called. So I'm going to use the real term, the official term. But it sounds way more complicated than what it is. To be honest, it's simply one of my legs is going to be further away. So from 65 to 75, I got $10. From 75 to 90, I got 15. So when I do that, the risk profile looks like that, meaning that now if I go higher than 275, actually I start losing money. Okay, but what happens to the cost of the trade? Now it becomes 17 cents. Okay, which is a very, very, very low cost. So what can I do here? I could play with the location of my units to try to maximize the best I can the performance and the cost of this particular trade. And I believe that maybe if I was to lower this by another and raise this by another one, maybe I will accomplish a little bit of a better effect. Yes. No, I didn't. 117. So no, it's not better. It is not better. Yeah, it is not better. So my first setup actually seemed to be the best, where I was looking at 265 and 285. This is generating a trade with a cost of 67 cents. Seems to provide the greatest profit where I need it to be. And if I was to combine this with my prior position that I was building here, where I was buying one of the 250, now I'm making it 265. I was selling one, now it's selling two of the 275. And then I buy one of the 285, correct? So, and those are call. So now I get a credit of $23. So I'm doing this for a credit. My delta is not humongous, which I cannot achieve a humongous delta. Why? Because how do you call it? The cost of the calls is too expensive, and therefore I would, no matter what, we need to use calls that are far out. So I will not be able to get that great amount of delta anyway. But now I have a much better theta effect as I am approaching my target, because both the puts are decaying as well as the butterfly as well. So if I graph it, it will look like that. Okay. So as long as the stock remains above 195, okay, you are going to make credit, which is 23.5. If it goes below 95, now of course you have risk, which is $1,000. Okay, to be precise, 976.5. Why? Because we are selling two puts with $5 distance between them to finance this trade, and therefore you have two times the risk of five, which is $10, which is $1,000. Minus the credit, so that's 976.5. Now, if the stock rallies, of course, now you start making money, and ideally, when you get to 273, you're going to make the maximum profit, especially if time has passed, because as time decay passes, notice how the line goes up, the dotted line goes up, and therefore you are increasing profitability on the way to expiration, and you're going to make more and more. So ideally, this trade doesn't happen too quick for you to profit at the best. Okay. So that would be my approach for this trade. Okay, that would be my approach for this trade, and hopefully this is a good exercise that we went through all those different possibilities. Please comment on the chat box if you followed the process and the rationale and the reasons why I went from bull puts to checking the calls to checking the bull call to then actually using a butterfly. I believe this is the first time we've done such approach in the session. Having said all of that, again, I would suggest not to click the button just yet, because this is, I would think, a pretty weak performance out of a $240 stock as an underlying asset. I'm, as I said, a bit disappointed. I'm pretty sure when the market opened and Apple continued moving lower, probably there was a greater amount of fear in the market, and there was a much better trade setup to be executed following the type of process and method and the type of plan I'm looking for. But right now I'm not super satisfied, so I'm not gonna take this trade. But I would suggest that it would not be a surprising thing if Facebook continues falling during the day, gaps down again into tomorrow, Friday, before the end of the week. You may actually find a much better setup if you replicate what I've done today in the following days, and I would certainly watch for it. Notice now how the credit is just increasing 30 cents, and this is just because Facebook dropped just 0 point something percent more. So if Facebook was to stretch itself for another 1, 2, 5% to the downside, you may have a way more advantageous setup. And by the way, last comment before we conclude the session, our closer of this. Okay, so you see now it's falling down, so some benefits are coming in from a premium point of view. But also I wanted to mention the fact that we are looking at UFOs that are super far away. Okay, we're talking about $50. Okay, so if we do the math, $50 of drop to get to 195 out of 241 out of $241 stock. So we are talking about another 20% drop. So it dropped already 25%. So we are now adding wiggle room of safety net of another 20% to the downside. So again, I'd be delighted to put this trade in place, but I need more premium to get a bit more delta juice and that's not that's that's what we have. Again, if you were looking at this setup using other time frames, you could certainly also do that, and I would not be surprised that you have an open gap here, um, significant turning points here as well. So maybe by using lower time frames, you get to see some UFOs located at a higher price point, around 220, something like that. And if you want to be more aggressive and selling your puts at these levels, you could indeed do that. And next thing you know, now you will be able to buy calls that are nearer and get more delta anyway. But of course, a 25% drop on a stock, which is very relevant in the US market, it's certainly concerning from a fundamental point of view. And even though it's not concerning, thinking that the end of Facebook is arriving, or Meta, uh, from a trading point of view, I would like to give myself as much wiggle room as possible, and therefore often patient space. I don't want fear of missing out to impact me in a way where I take the trade too soon. Of course, I may miss out if I wait too much. Patience may be your enemy too. But in this case, I would like to give this opportunity to Facebook to scare people a bit more, get a bit lower, a bit closer to 195. And I believe this trade setup would be very powerful with a decent amount of delta now, instead of a disappointing amount of delta as we have now. So we'll be meeting again next week. We may talk about it again, depending on what happened. Feel free to tell me, shoot a message, shoot an email if you want, to let me know if you got into a setup, if you reassess the trade tomorrow, you found a good setup and you got into it. Again, we'll talk about it, but not for me today because of the reasons I have described. Last comments. Two bull puts will pay for the fly. That's exactly what I have at this moment. In the setup, I was using two bull puts. Yeah. Yeah, Mark, you will need to watch, no problem. And also, Christian, like it, please compare the buy of the long stock with stop in terms of risk and reward. Well, the buy of the long stop is going to be better compared to this trade. Most of the times when you add credits into the mix, most of the time you are also adding negative gamma. Therefore, the performance will suffer a little bit of a penalty, even though from a margin impact point of view, from a cost of the trade point of view, it's very advantageous. So if you're right on direction, so having the stock with a stop will perform better. If you're wrong on direction, my setup is going to be way more efficient because you can afford Facebook to drop another 20% and it's not going to hurt you. So certainly in a situation like that, I would prefer to add that safety net. Then the other thing is that if we are talking about risk and reward, and you want to be exposed with very hard deltas, which is long stock, meaning full delta exposure, 100 delta, right? Then I would say, just put yourself some sort of a call spread, like the call spread. Did I close it? I'm not sure if I closed it. Let me see. Probably I did. Yes, I did. So the call spread we have calculated earlier, when we were looking at the target to be 273, I think it was. 273. Here we go, and we send to the strategy builder, right? And we looked at the return on investments, right? And you can see that a long call is going to give you 133% return if you're right on your trade. A bull call spread is going to make the cost to be way less, and you got 120% return. There's no way you're going to make 120% on Facebook anytime soon from now until March 3. I mean, could it happen? Anything could happen, but that would be more than doubling its value, right? That would mean that Facebook in less than a month is trading at almost $500 per share instead of 240. So I guess it's fair for me to say it's not going to happen. So if you really are looking at reward to risk ratios, then a spread or even a long call, even though long calls now are probably way too expensive, but a spread is probably going to be the way to do it to improve your reward to risk ratios and get that strong delta exposure if you want to do that. In my case, my approach here was conservative, very conservative. Like, I don't know why that stock is dropping 25%. I know it's a relevant company, but the fact that it's dropping 25% is very concerning. What if it drops another 10, 20%? I'm giving myself that safety net instead of getting exposed with plenty of deltas out of the bet, okay? Or long stock, which is even more exposure. And also, very good point, Christian. Wait for green UFOs. Absolutely, okay, absolutely. That would be another way to approach it. But then, to do this safely, okay, I would not only wait for green UFOs to show up here. Okay, I would not only wait for green UFOs to show up. I would actually wait for the climate to become blue and confirm, which right now is not. Okay, so if the climate becomes blue and confirm, and you got green UFOs, then that's a different type of trade. Now the market environment has changed, and now you are in a safer position to go long. Now you are in a totally reversed climate. You can see this very long line to the bottom part. Okay, and then obviously, yeah, so, adding a safety net makes sense, especially if you have the same mentality I have as a trader, which it's fine if you don't. You may be more aggressive than me, Christian. It's absolutely fine. Okay, aggressive is a to be honest, I don't like that word, which is commonly used in trading, because it's like aggressive is almost like if I tell you what you're doing is wrong. You know, you are taking this risk. You're an aggressive guy. Well, it's absolutely fine to be aggressive in trading as long as you manage your risk, and you do. If you have a stop on your shares, or you're using spreads, which are limited risk by definition, it's totally fine to be aggressive. It just happened to be that I am less aggressive, and when I see a move like that, even less. Okay, but nothing wrong with being aggressive. Okay, so don't think of this word as a negative thing at all. What would be a decent amount of delta, Mark? That's a difficult answer, to be honest, because different stocks, different situations will give you different opportunities. I'm looking at this trade as a unique opportunity. It's like when, for example, Volkswagen was caught with faking the pollution values, right, that they reported, and then the stock dropped like 40%, I believe it was, in like 2-3 days, 1 week. And getting into one of those trades was a unique opportunity. Or Facebook now, to me, it's a unique opportunity. At the same time, those unique opportunities come with the problem of uniqueness, which is you cannot have a trading plan where you're going to be rigid with specific rules. Like if you trade, let's say you trade futures intraday, right? And you're going to be like, okay, so when this happens, I take the trade. When this doesn't happen, I don't take the trade. And you can be absolutely rigid, and you should. In this case, we are dealing with different expiration dates, options, unique opportunities. So again, you need to overlay common sense on top of the trade plan to make sure that you're in a position that is actually reasonable. And therefore, what's a decent amount of delta is difficult to answer. I would say that anywhere below, let's say 15 delta, would not make me very, very happy. I'm not shooting for a great amount of delta because I'm adding that 20% buffer of safety net. So I know my delta will never be a great delta, but I got a delta of 5 a moment ago. So it's really, really nothing, right? It's basically you are playing time decay. Basically, you are not playing direction. So I'm not happy enough with that. Okay. Now, if you got a 15 delta, is still not too much, but then you got some positive gamma, depending on the trade setup you have. Like if you have a long call or a bull call spread, you have positive gamma. So that 15 delta will become more as the trade moves. So I'll take it. Okay, assuming that the setup is valid. I got my UFOs, I got my speed bump, all of those things. I'll take it. Other cases maybe 13 delta. Other cases you may be luckier based on how options are being priced and the underlying asset and where the UFOs are and where the speed bump points at and all of those things. And you may get 30 delta. I would say that would be a rare case, but it's possible, and then I would be happier. So again, common sense is to be added to planning a trade of this sort because it's a unique opportunity, and therefore you need to be a bit more flexible and less rigid. You guys know me well. You've been in the sessions for a long, long time, and I'm all about rule-based and being disciplined and everything else. But those are the times where you have to be a bit more flexible. Okay, Christian, to sum it up, would be to wait for autoclimate to confirm the direction down or up, in my view. Yes, if you want to do that, this is indeed the best setup to get a great amount of delta, but it may also be a less efficient case in the sense that, let me show you one more thing. If we add DT trend, right? And I look not at the symbol, but I look at the group. So what's happening to computer services? It's on the red. What's happening to the sector, which is technology, is in the red. So it's not like we're dealing with a sector which is very strong, and that's the other reason why I'm adding that safety net. Okay. Therefore, waiting for the climate to be blue and now you go for it makes sense, but you would be dealing with a weak sector and a weak group, and we know stocks are fragile, which is the first comment of the session today, I believe it was. So I rather, in a setup like this, I rather make myself safe with a big buffer that allows me to be wrong, instead of plan the trade trying to be more aggressive with the deltas, which is not wrong, but it carries the disadvantage of being more aggressive, which is you may lose more often. It also carries the advantage of being aggressive, which is you may trade more often, and when you are right, you profit more, which at the end of the game, would provide results which are absolutely fine. There is nothing wrong or right by being or not being aggressive or being or not being conservative. It's just a matter of trading style, trading plan, trading psychology. We are all different, and therefore we got pros and cons. I mean, we will not be talking about pros and cons and trading profiles or trading styles if we could predict the future using a crystal ball. We cannot. So that's when all of this comes into place. So we can be confident and comfortable when we execute. Because if what we do is not in line with our personality, then you just cannot click the button, because you will always be undecisive or uncomfortable, and then that's not trading. Okay. But anyway, great conversation, guys. Sorry for surpassing by 15 minutes. That's a lot. The ending time of the session, but I really, really appreciate your comments, guys. This is again a good conversation to have in a special day where key stock in the market is dropping by 25%. And I'm happy we are meeting live today and we're having this chat. Yes, absolutely, guys. Thank you so much, everyone. See you soon. You guys take care. Keep up the good work. Okay, and we'll see you soon here in the room. Bye, everyone. Take care.